what is the outlook for the US dollar as a whole, given that the markets and the Fed are pricing in two fairly different scenarios?
Yeah, that's right. So, we've seen that Treasury yield pop above 2.5%, which looked like it was an accident waiting to happen. But given the way that risk sentiment has come out of the box at the beginning of the year, and given further support for the idea of this strong globalized, synchronized global uptrend, I think that it was only a matter of time before Treasury yields started to reflect that. And so I think that was the reason. I don't really think that the BOJ's policy tweak, if you like, yesterday in terms of buying fewer ultra long end bonds was really the catalyst. We didn't see much of an uptick in treasuries, but so I think the question is, if the treasury market is now rising, moving back into a high yield environment, how far are we going to get? Are we going to start cracking that kind of 2.6% yield range top that we saw last year? It's certainly providing a little bit of support for the dollar, but a lot of question marks over whether we will see the kind of incremental portfolio flows on the back of those higher yields sufficient to support the dollar. Our view is it may be more reflected later in the year against things like commodity currencies and EM, and maybe even the Japanese yen, rather than other majors. So looking at like the euro and sterling, for example. So so we're very selective in where we think dollar strength is likely to show up this year. And if we look at it in broad index terms, in fact, our view is that even in a slightly higher US yield environment, and even if the markets have to move to think that the Fed will do at least 3 and possibly more rate rises this year, in broad terms, the US dollar is likely to be lower rather than higher for much of 2018.
Well, what's happening in Japan, and what does that mean for the dollar yen? I mean, you're saying that what with the news that we've heard late yesterday is not indeed a policy shift, and pretty much more of the same, but it looks like the market's taking it as a policy shift.
Well, that's right, and I think that I think on reflection, the market may have to have a pause for thought, really, in terms of how it's interpreted this, because I think is what it's really. I mean, for one, the announcement didn't come from the Bank of Japan; it came from the kind of financial markets department, basically. And I think the reality is that Japan needs to buy far fewer bonds in order to maintain a commitment to its so-called yield curve control policy. And there's no lessening, in our view, of the commitment to keeping 10-year JGB yields close to 0%, and a slightly steeper curve at the back end engendered by this move is probably something that's welcome. It's good for the performance of the financial sector, so it could be good for stock markets. But with US Treasuries on the increase, and by much more than any backup we're seeing in Japanese yields, that's actually a driver of dollar yen strength, it should be, rather than dollar yen weakness. So in that sense, I think this yen strength that we've seen yesterday and today, that amounts to what, almost 0.75%, I think that is a dip that in the cold light of day is one that should be bought.